You ever get that feeling like, okay, things are looking up and then bam, everything changes?
Like the rug's been pulled out from under you?
Exactly. Like in 2011, remember, the market was, showing signs of life after the whole 2008 mess.
Yeah, kind of bouncing back a bit.
And then suddenly, a nosedive.
Yeah.
The S&P 500 tanked like almost 20% in just a few months.
Trillions, literally trillions of dollars just gone. Poof.
Makes you wonder, right, how much of this investing game is, well, just a game? I mean, how do you make sense of that kind of volatility?
It's a great question. And it's really at the heart of what we're diving into today, this whole idea of contrarian investing.
Right, because when everyone's running for the hills, maybe that's the time to, I don't know, take a closer look.
Potentially, yeah. And to understand that, we're turning to the work of David Dreman.
The dean of contrarians, as they call him.
Exactly. And his firm, they've been putting these contrarian strategies to work, managing, get this, billions of dollars.
So this isn't just some ivory tower theory.
Definitely not. It's battle-tested. And for you as an investor, what's really interesting about Dreman's work is that he goes beyond just the numbers.
Like he's trying to get inside the heads of investors.
Precisely. He's looking at the psychology, the emotions that drive those often irrational market swings.
And that's what we're going to unpack today, those psychological quirks that can make markets overreact, get too optimistic, too pessimistic.
Yeah, both sides of the coin.
And we'll explore how Dreman's contrarian strategies can, well, potentially help you navigate that madness, maybe even find some hidden gems that everyone else is overlooking.
We're talking about real insights here, things that can change how you approach investing.
So let's get into it. Dreman lays out a lot of this, particularly in part 4 of his book, Market Overreaction, the New Investment Paradigm.
He really makes the case for using these contrarian strategies to account for the fact that we're all human, right? We make mistakes, we let emotions influence our decisions.
We're not always perfectly rational robots.
And these strategies, they've got a track record, a history of actually outperforming the market. And not just in good times, but in some really tough periods too.
Like the lost decade, right?
Yeah.
In the first 10 years of this century, not exactly a smooth ride.
Not at all. And when you look at those specific events, like the dot-com bubble, the financial crisis, those contrarian approaches really showed their worth.
Because it's not about avoiding losses altogether, right? I mean, that's unrealistic.
Absolutely. But it's about potentially mitigating those losses, not getting caught up in the frenzy and riding a stock all the way down.
And Dreman's no slouch. He constantly reevaluates his strategies, learns from past events. Like after 2008, he added even more safeguards based on what happened during that crisis.
Shows you he's committed to continuously improving these approaches for investors.
And speaking of 2008, I mean, talk about market psychology gone haywire.
Oh, absolutely.
Remember all the panic? The rumors flying around about banks collapsing left and right.
It was a scary time, no doubt.
Even the president had to step in, try to calm everyone down.
And it shows you the sheer power of fear and uncertainty in the market. I mean, it can take over so quickly.
And it's not just these massive systemic events. Dreman tells this story about getting caught up in the go-go bubble back in the late 60s.
Early in his career, yeah.
And it shows you even the experts can get swept up in the hype.
He's not immune to it.
He talks about this concept, the greater fool theory, where basically you buy something overpriced hoping to find someone even dumber to sell it to for even more.
Oh, yeah. It's like a game of hot potato, except with potentially disastrous consequences.
He even quotes this British MP who lost everything in the South Sea bubble way back in 1720. This guy knew it was going to crash, but he thought he could get out in time. Didn't work out so well.
A cautionary tale for sure.
Now, we know a lot about the psychology of investing. Cognitive biases, social influences, all that stuff. But Dreman argues that these explanations, they don't fully capture the picture.
Like there's something else going on.
Yeah. He says it's not just about our conscious thoughts, but about this deeper level of feeling, what he calls affect.
Like gut feelings, intuition.
Exactly. It's that emotional response that can sometimes override our rational analysis.
And it's tricky, right? Because sometimes those gut feelings can be spot on.
Sure. But when it comes to investing, Dreman argues that relying too heavily on affect can be really misleading.
It's like that saying, if your gut was always right about money, you wouldn't need a brain.
He gives this example with Merck, the pharmaceutical company. You see some positive news and you get excited, maybe buy the stock, without really digging deeper. That's affect at play.
And that excitement, that desire for big gains, it can cloud your judgment, make you overlook the risks.
He talks about the dot-com craze, how everyone was so focused on the potential upside that they ignored the crazy high valuations. There's a table in his book, Table 2.1, showing these price-to-earnings ratios that were just through the roof.
Oh, yeah. I remember those days. It seemed like every tech stock was going to the moon.
And even though there were clear signs that these companies were overvalued, a lot of people, driven by this positive affect, convinced themselves it was all justified.
They were seeing dollar signs, not red flags.
And then, of course, the bubble burst.
Ouch.
So beyond effect, Dreman digs into these specific mental shortcuts we use, called heuristics. They're often useful in everyday life, but when it comes to investing, they can lead us astray.
Like making decisions based on incomplete information or outdated patterns.
Yeah, like the law of small numbers. We see a company or a mutual fund do well for a short period, and we extrapolate that into the future.
Like that hot new fund everyone's piling into.
Exactly. Using the example of the Janus fund after the dot-com bubble. It had amazing short-term gains, but in the long run, it didn't live up to the hype.
It's that classic mistake of thinking a short-term trend will continue forever.
He also talks about how we overreact to economic news, even those flash statistics that are often revised later.
It's like we're desperate for any new bit of information to confirm our biases.
And then there's information overload, TMI.
Oh, yeah. We're bombarded with so much financial news these days. It's overwhelming.
And Dreman argues that all this information can actually make it harder for us to make good decisions.
Our brains just can't process it all effectively.
He talks about heuristic math, this belief that there should be a direct relationship between certain factors, like consistent sales growth and future earnings. It makes us favor companies that are predictable, even if they might not be the most profitable in the long run.
We like the comfort of knowing what to expect, even if it means settling for less.
There's also anchoring, where we get stuck on a particular price point for a stock and have trouble seeing beyond that.
Like we're anchored to that initial price, even if the fundamentals have changed.
And then there's hindsight bias, which is really dangerous.
Oh, yeah. That's the I knew it all along phenomena.
Makes it hard to learn from our mistakes because we rewrite history in our minds.
It's like we convince ourselves we could have predicted the past, even though we couldn't have.
Dreman uses the 2008 housing crash as an example. While there were warning signs, the full extent of the risk wasn't clear until it was too late.
But looking back, it seems so obvious, right? That's the hindsight bias at work.
So all this talk about psychology, it challenges this whole idea of the market being perfectly efficient and rational.
You're talking about the efficient market hypothesis, EMH.
Right. This was the dominant theory in academic finance for decades. The idea was that all information is already reflected in stock prices, so there's no point in trying to beat the market.
Just buy an index fund and call it a day, right?
But then real-world events happened, and EMH started to crumble.
Like cracks in the foundation.
The 1987 crash was a big one. Liquidity dried up, and those fancy EMH-based strategies like portfolio insurance, they actually made the crash worse.
It was a wake-up call.
Then you have the collapse of long-term capital management, LTCM, in the late 90s. This is a hedge fund run by some of the smartest guys in finance, Nobel Prize winners, the whole 9 yards.
They were using all these complex mathematical models.
And their strategy was based on this idea that volatility was predictable. But then a few unexpected events happened. The Asian financial crisis, the Russian debt default, and their whole house of cards came tumbling down.
Even the best minds can get it wrong, especially when they're relying on models that don't account for the unexpected.
And then, of course, 2008, the housing bubble. Those mortgage-backed securities, even the ones with AAA ratings, they tanked.
Another example of how relying on past volatility to measure risk can be dangerous.
And that brings us to beta. For decades, this has been the go-to measure for assessing risk in investments.
The higher the beta, the riskier the investment.
Supposedly. But research has shown that the relationship between beta and actual returns is pretty weak and inconsistent.
Even Eugene Fama, one of the fathers of EMH, admitted that beta is dead.
Pretty big statement. And yet you still see firms like Morningstar using beta in their risk assessments.
It's amazing how long it takes for these ideas to filter through the system.
So if beta isn't reliable and EMH is flawed, what does that mean for how we understand the market?
It means we need a new framework, a new way of thinking.
And that's where the investor overreaction hypothesis, IOH, comes in.
Ah, yes. This is Dreman's preferred approach.
It's based on the idea that psychological forces can create these predictable patterns of overreaction in the market.
So instead of assuming investors are always rational, IOH says they're often irrational and in predictable ways.
And this has big implications for investors. IOH predicts that popular stocks tend to become overvalued, while unpopular stocks tend to become undervalued.
And eventually, these mispricings correct themselves.
So what does the evidence say? Well, long-term studies of low price to earnings, PE, stocks have shown they consistently outperform the market.
We're talking about decades of data here.
One study, for example, looked at a 41-year period ending in 2010. Low PE stocks averaged a 15.2% annual return, compared to 11.6% for the market and just 8.3% for high PE stocks.
That's a huge difference over time.
And these cheaper stocks often have higher dividend yields, which can provide a cushion during bear markets.
Plus, you don't have to trade them as often, so lower transaction costs.
And it's not just about PE ratios. Strategies based on other value metrics like price-to-book value and price-to-cash flow have also shown strong performance.
So the evidence is pretty compelling.
And you can even apply these contrarian principles within specific industries.
Well, how's that work?
You look for the least expensive stocks within a particular industry, regardless of how the industry as a whole is doing.
So you're basically betting that the market is overreacting to something specific to those companies.
Exactly. And the research shows that this approach also tends to outperform.
Fascinating.
Now, we can't ignore the impact of technology on the market. High-frequency trading, HFT, has introduced a whole new level of volatility.
Oh, yeah. Those algorithms can move markets in the blink of an eye.
Remember the flash crash of 2010 and the market turbulence in August 2011?
Scary stuff.
There's a lot of concern that HFT is making the market more risky and unpredictable.
It's like the machines are taking over.
So, given all this, what can you, the individual investor, do? Well, Dreman suggests a few things. First, stay the course. Don't try to time the market.
Easier said than done.
Right, it is. But trying to predict short-term market movements is a fool's game.
Better to focus on the long term.
Absolutely. Second, diversify your portfolio. Low-cost ETFs can be a great way to do that.
Spread your risk across different asset classes.
Third, be wary of complex, volatility-linked products like VIX options.
Those are for the pros, not for the average investor.
And if you're looking at mutual funds, choose ones with a long track record, at least 10 years, and ideally with the same manager who's been there the whole time.
Experience matters.
And if you're interested in international markets, consider foreign stocks that trade on U.S. exchanges as ADRs.
A way to tap into global opportunities without too much hassle.
Now, one of the most important things Dreman emphasizes is taking a long-term perspective.
Patience is key.
He points out that over long periods, inflation and taxes can really eat into the returns of safer assets like bonds and T-bills.
You might think you're playing it safe, but you could be losing purchasing power over time.
And historically, stocks have a much higher probability of outperforming bonds and T-bills over periods of 20 years or more.
He even quotes Richard Thaler, who suggests that checking your stock prices less often might actually lead to better decisions.
Out of sight, out of mind, right?
Less temptation to react to every little blip in the market.
Now, for some broader context, Dreman briefly discusses the financial crisis of 2007-2008. He talks about deregulation, the growth of derivatives, the subprime mortgage market, all those factors that contributed to the meltdown.
A complex web of interconnected risks.
And he touches on some of the challenges we're facing today, like the complexities of free trade and the potential for future inflation.
Things that could have a big impact on your investments down the road.
So to sum it all up, understanding the psychology of the market, the way investors overreact, is crucial for making smart investment decisions.
It's not just about the numbers, it's about understanding the human element.
While predicting the future is impossible, a contrarian mindset, a focus on long-term probabilities, and an awareness of your own biases can help you navigate the market more effectively.
It's about being a step ahead of the crowd, thinking differently.
And here's a thought-provoking question to leave you with. Could this new psychological way of investing actually be more robust, more resilient than the traditional approaches that often ignore the human factor? It's something worth pondering as you continue your journey as an investor.
Food for thought indeed.